Hello, ladies and gentlemen. This is Ashraf Laidi, and welcome to this first of what will be a series of videos that I'll be doing in the month of November between Ashraf Laidi, and Eightcap, right on Trade Zone. And the videos will be starting on the first week of November, but this is a special opening video ahead of the Federal Reserve decision on Wednesday, which is, pay attention please, on the screen here, which is 6 p.m. London time and 7 p.m. Central European time, because Europe and the UK and Europe has gone back an hour and the US has not yet done so. The US always done it a week later. Therefore, the Federal Reserve decision, okay, the Federal Reserve announcement is going to be at 6 p.m. London time or 7 p.m. Frankfurt, 7 p.m. Paris, 7 p.m. Madrid. You get the picture, okay? And if you happen to be in the Middle East, then it is most of the Middle East does not change the time, so the time is going to be an hour before the usual, okay? So in Dubai, if you're watching this, it will the decision 6. So now the difference is 4. So the decision will be at 10 p.m. Okay. So again, 6 p.m. I just wanted to get that out of the way. All right. So let's just get to it. So in this video, we're going to focus on indices. Okay, we're going to focus on gold. We're going to talk about the 3 major indices, and we're going to look at the 10-year yield and metals and a few other things, and also the euro dollar and dollar yen. Are they going to intervene? Is the Bank of Japan going to intervene? But before I start all of this, just want to get straight to the Federal Reserve decision. So the Federal Reserve this Wednesday is widely expected to keep rates unchanged, okay? To keep rate unchanged. And what is important about this decision is what will be in Jerome Powell's speech, okay, in his press conference to come in at half hour after the announcement. What will be in his speech that will alter, that will change the expectations for the December meeting? Currently, you see this here, what it says? So here, it says November 1st. So the Fed Funds futures is pricing zero chance of a rate hike on Wednesday, November 1st. But for the December 13th meeting, it is pricing at 21%. So basically, it would be interesting what would those probabilities be as Powell speaks, after Powell speaks, and when the meeting is over, and when the speech is over. Will it be 40? Will it be 30? Now, so this is really important. But what could they say? What would they be saying that will alter this? Now, let's. What's important is that this meeting does not contain the dot plot. Now, I'm not sure about the audience of this. I'm sure the audience of this video is a wide range, but I'm from people who are beginners to purely quants, purely technical, those who pay attention to the news and to the fundamentals. But I'm not sure to which extent is one more than the other. But regardless of that, whether you are a purely technical or a quant or Elliott wave trader or anything, one of the things that it's important to know is that 6 p.m. London time Wednesday, again 6 p.m. because of the change of the hour, just for this meeting, or 7 p.m. European time, or like I said, 10 p.m. Dubai time. What is important is that there will be no dot plot. You know those dot plot, those graphs, those forecasts that the Federal Reserve will be issues every 4 times a year. Well, it only issues them at the December meeting, March meeting, June meetings, and September meeting. It does not issue them in November meeting. What does this mean? This means that in the opening statement that will come out, at 6 p.m. London time, there will be very little to glean from expectations. They will change the wording. They will probably say, there will likely 99% chance they will say that the job on fighting inflation is not yet done, but we have to keep rates unchanged and keep them higher for longer. Well, higher for longer, he will say it in the press conference. And they will say that we're starting to see improvement in inflation, meaning it's moving in the right way. It's moving down, but it's not yet vanquished. So this is what's important, but that will cause very little movement in the market. It may cause noise right after the FOMC statement, but the usual verbal landmines come out when Powell speaks. So let us start here with let's start with gold. So if we go to gold here, what you will see, it's back at that familiar, some people call it the triple top of 2000. Okay, the geopolitical situation is probably most widely associated with the most fundamental explanation to why it is rising. Even though if it's a pure rise of geopolitical threats, it will be rising gold, rising oil, and rising bond prices, meaning falling bond yields. But with the oil situation, it is diminishing. So the oil is the one that is least reluctant to rally, or it does rise, but it retreats. But gold is pushing higher because of other reasons, and it's very important to specify there are other reasons why they're pushing gold, and one of them is to do with the near approachment of another sort of a debt ceiling problem in November in the U.S. But most important is that the market all knows now that the Treasury will have to borrow further in order to repay existing debt and so on and so forth. But here is what's important from the technicals. So if you look at gold, ladies and gentlemen, if you see the big or the major gains from the key lows, there is a recurring pattern here, which is basically they rise 10%. And when they get 10%, they sort of stop and they do retracement. So and actually this is almost exactly $200. So the low in this cycle here, well, not this cycle, but the low of the last few months, that happened in October 6th, is basically the low is 1810. Okay, but the high is 2010, and this is approximately around 10.5%. What is interesting, I'm going to take you to a whole different market. So a whole different market here, which is basically, if you look at major indices, the NASDAQ, the Dow, and the S&P, they're all down 11% from the top of the top of the summer. They all stabilize around 11%. So this is the NASDAQ, this is the S&P, and this is the Dow Jones. Now, I'm going to go into the S&P in further detail. There's something very, very important in the S&P that I would like to pay attention, and on the VIX also. But before I do that, I'll also talk about Bitcoin. I'm going to go back to gold. So here, basically, if you look at gold, what is interesting is that if you look at the RSI, oh, by the way, for those of you who are wondering what are these three moving averages, I always have these three moving averages in most of my charts. The 55, which is the purple, the 200, which is the yellow, and the 100, which is the green. But what is interesting, if you look at the RSI, what do you notice? You notice that for the very first time in a long time, the RSI went above 70%, okay? And each time it goes towards 60, 70%, there is some sort of retracement. Not the first time, probably the second time. And this is what usually does. And a common error that people make is that whenever they see the RSI touching, 70% or 71%, they say sell. That is totally wrong, because it depends what RSI are you doing it. Are you seeing it on the weekly? Are you seeing it on the daily? Are you seeing it on the 4-hour? But what's important, the daily chart, which is seen by many asset managers and portfolios and traders. Look at this. So basically, if you pay attention to this chart, you will see that. So last week we went above as high as 74, and it could be expected we're going to have some sort of retracement. Look at here. The last time we saw this was in March, okay, and see this retracement here. And again, the retracement happened after 11% increase. And what else? Here, it went, guess what? We went to the RSI. It was 1114 last year, okay? RSI slowly went above, slightly went above 70%. It was also a 10% gain. And then we go here, in here, look at this. Again, 10% was a gain. Do you see this move here? This is February 2022. This is the second time in the history of gold that we went toward 2000. The first time was obviously in August 2020, but the second time was because of the Ukraine war, and we had a big jump and we came back down. So that is what's important. Therefore, ladies and gentlemen, there is something also very, very important that you need to pay attention. That is every month, around the 30th, the 31st, depending on what the duration of the month, there is something that is called the end of month fluctuations, and there are inexplicable moves sometimes in the end of the month. What I mean by inexplicable, the usual correlations that you usually see, the most common ones, rising gold, falling dollar and vice versa, sometimes they don't really work at the same time. Or maybe sometimes bond yields go up and gold goes down. Well, around that funny time of the month, the correlation changes. So you may see bond yields going up alongside gold or vice versa. But what's important, so because of that element, I think there's a very good chance that you might see some sort of retracement or pullback from 1999, from 1998, and we could go back down as low as the previous high, which is as low as 1950. Now, what would it take fundamentally for gold to come back down below 1960? It will have to take a very hawkish Powell, okay? And that could very well be the case, because Powell did not raise rates, is not going to be raising rates this month. He didn't raise rates the month before, and he's going to want to come in, and he's going to tell the people, that even though he's not going to tell them, but this is why he wants the message. Even though there is no rate hike, he's going to leave markets expecting that the rate hikes are staying higher for longer, and not raising rates in November does not mean cutting rates soon. And this is the message that he needs to send. Okay, this is very important, because there is something called the bear steepeners, which I will not mention in this video, but I'll mention in the next video on Trade Zone on bond yields, which is quite worrying. So the last thing, if you ask me, if investment-wise, I am long-term bullish gold. I still think that we're going to go toward 2,100, 2,300. But in this cycle, there's a chance that we may have to go towards 1960, 1970 before we push back higher toward 2,000. And fundamentally, gold needs to have a spectacularly powerful, fundamentally positive driver for it to go above 2,000 and to stay above 2,000. Okay, but what is important is that you need to pay attention to these 10% gains, and each time when they combine with an RSI above 70, there is room for a pullback. The pullback to come in after Powell, it could come in ahead of Powell, and be careful of right after the decision of the FOMC, you will see gold moving, $10, $17, and you go and you buy at the top without a stop. Be very careful with that. Let's just go now to the indices, and this is something that I've seen. Before we go to indices, we can go to the VIX, and the VIX is basically the fear index, and it goes up. Basically, the S&P usually drops. And what is interesting is that there's a recurring pattern here. So I think that the VIX could make one more jump towards 22, but 23.8 is the big resistance. That could coincide with a kilo in indices, okay? So, but this is what I want to pay attention. So if you look at this, what happened last week is if you look at the NASDAQ is still close to the 200-day moving average, okay? It still hasn't reached it. And the key moving, and the 200-day moving average is around 13,900. In our service with AshrafLaidi.com, back in August, we looked at the head and shoulder formation and we said 13,500 could happen. So it could be still a level. But the key levels here is that we could probably easily go towards 13,900 and even 13,900, which is a 200-day. Okay, so from a time cycle analysis, we could see a low coming in either the end of this week or early next week from a time cycle analysis. Okay, the S&P, which I trade a lot because it takes less margin, has already fallen below the yellow, below the 200-day moving average. And now I'm going to go deep into the S&P, and this is the following. So we broke below the S&P, and you can the 200, and you can see the 200 here coincides with this low. So there's a very good chance, I think, that we're going to go towards 4,070 by the time you see this video, by the time this video is rendered and it's sent to Eightcap and they process it and they send it to you. I don't know, the market would have probably moved, but here is what you need to pay attention. So I said I look at the 55 moving average, the 100 and the 200, but I made an exception. And the exception is that the yellow here remains at 200, but the purple is the 350. And there is this pattern with the S&P, is that look at the 350 day, which is the purple 350-day moving average. It was a low here, it was a high here, it was a high here, it was a high here, it was a low here. But what's important, there is more to it. The way I look at this is that whenever the S&P fell below the 200-day moving average, and it would pause at the 350 and it would rally back. Will it do it this time? So it has done it, and you can do this at your own time, okay? You can go to your own chart and you can look at the 200 and the 350, and you can see, so for instance here, you see this example? We fell below the 200, we respected the 350, okay? It happened many, many, many times. Look in here, so it happened here in October 2016, here, you see this? In 2018. So what am I saying here? And it happened here, it happened here, and it happened here. Most recently, it happened on February 18, 2022. Again, February 2022 is the peak in gold, which is basically when Putin invaded the Ukraine and started the war. So we saw this fear. We fell below the 200, but we respected the 350. Will it be the same thing now? Things are tougher. Things are harder. Yields are higher. There's more geopolitical risks. But I think that there is a very good chance that we could break it slightly. So what I'm trying to say is that, so if you think the low is 4,070, if you want to come in with some trades, if you want to go and buy the dips, okay, let's say here's an example. If you want to go and buy the dips, you can put some if done orders, you can put some orders, entry, around 4,100 or 4,110, okay? And you can target 4,150, so that's 40 points. And you can put in a stop below 4,000 and let's say 80. So that's an 80 pip stop and a 40 point gain. It depends on your risk tolerance. What's also important, ladies and gentlemen, for trading, it does not only matter just about your risk-reward ratio, whether it's or reward-to-risk ratio, whether it's 3-to-1 or 2-to-1. It does not only rely on that. It also depends on the use of the portfolio, on the size management, okay? So if you mean to tell me that, oh, look, I am going for a reward-to-risk ratio of 3-to-1, that means if you are at 4,100, okay, in the S&P, and let's say I am targeting 4,060, okay? So you are at 4,100, so let's say the example right now, the S&P is at 4,100, meaning 4,100, okay? and you want to target 4,170. Okay, that is 60 points. And you say, oh, I'm targeting 60 points, but I'm okay. I'm only risking 20 pips, which is 20 points. So you are targeting, so you have a stop at 4,090. Okay? When it goes 4,090, you put a stop. But you are targeting as much as 4170. So you are targeting 60 points, but you have a stop of 20. So that's a 3-to-1. Okay, so that's fine. But if you're using 80% or 70% of your account in this trade, that would be a problem. Okay? That would be a problem because you could easily be margined out. So, but having said that, I really think that if I were to make sort of a general assessment here, I would say that the S&P is vulnerable to going towards 4,090, 4,080, even 4,070, and then to stabilize there. The NASDAQ could come in a little bit lower. I think NASDAQ could go towards 13,800 or 13,700 as long as bond yields push higher. And what I mean by bond yields, ladies and gentlemen, is this is really, really important. A lot of people don't pay attention to this, is 10-year yields. So one of the things that retail traders do not really pay attention very much to is that when bond yields push higher, this could be a problem for indices. And as long as 10-year yields here, as long as they do, they remain above 485, okay, 484, there is still risk for the NASDAQ. Now, let me talk about since I'm talking about this, I will talk about dollar yen. And the Bank of Japan has made its biggest intervention to date on October 21st last year, if you remember. Okay, so it was here. It made 3 interventions last year, and the second one was the biggest. It was a Friday, October 21st, and it led to basically, it coincided with the peak in dollar yen and yields. Now, this year it made 1 intervention early October, but it did not confirm it, but it was actually obvious that they did it, and the fact that they chose not to confirm it was actually a confirmation in itself. But I do think that they are trying to save their armory for the Federal Reserve. If the Federal Reserve decision is going to be hawkish and it's going to drive the up yields and it's going to drive up dollar yen, then they will probably come in and have to intervene. And if it goes towards 150.7 or 150 or 151 or 152, it could drop as much as 400 pips, meaning it could go all the way towards 147. Let's talk about euro dollar. We don't want to make this video too long, but there is some sort of disputable inverted head and shoulder. So as you can see here, let's start with the big picture and then we zoom in. So there is sort of a left shoulder here, 1034. There is the head 96, and then there is a right shoulder. This is an inverted head and shoulder. This is a positive formation. But let's just focus on the green rising trend line support, which continues to hold here. So if we do break, so there is room here for the pre-Fed movement. So we could easily go back towards 106.90 or 106.80. But really, I think that there is room for just scalping or for day trading just around between 105.80 and 106.20. But the trend line support here, if we do break below 105.50, it's not going to be the end of the year. There's still further moves here. We could go all the way towards 105. But what's important is that even if we go towards 105 or 104, it does not mean we're going back towards 103. Okay, so these are just the key levels. I hope I decided to touch on the ways that I approach the market and on the key markets here in approaching the Federal Reserve decision. Once again, it's going to be 6 p.m. This time it's going to be 6 p.m. London time, 7 p.m. Central European time on Wednesday. Okay, it's not going to be the usual time, 7 p.m. London or 8 p.m. Europe. And for those of you in the Middle East, it's going to be 10 p.m. by the time. Okay, so I hope this will work out for you guys, and best of luck, and we'll see you at the next video on Trade Zone with Eightcap.